trading ideas that you can implement in your account today without you having to pay a dime and still join us for these free presentations. If you want to need more support, it's available in person and online, and we'll talk about that later on in the presentation as well. Now what I hope, what you should expect from this presentation and what I hope to give to you in this presentation is we're going to identify what the problem is in trading stocks and options. We'll learn why most investors haven't solved it yet. They keep trying, but they keep suffering for specific reasons. We're going to show how to use the Power Options tools to help you solve this problem, and the methodology, of course, that entails solving the problem. We're going to discuss a few income methods and adjustments using the Power Options tools and some of my actual recent trades. Finally, we're going to discuss what steps you can take next to further your education and get the full details of the radioactive trading methodology. All right, so that's the background. Those are the basics. Let's go ahead and talk about what this setup entails. And we're going to review a position from about a year ago on Green Mountain Coffee Roasters. Now, Kurt made a profit on this position without an adjustment, without using the income methods. I'm sorry about that. There we go. On April 22nd, 2009, Kurt bought 200 shares of GMCR at $54.20. At the same time, he bought 2 September 65 puts for $16.70. Now that looks expensive, and this is the very same thought I had when I first met Kurt, and he called me on the phone and he was trying to use the Power Options tools. When I first looked at a setup that was similar to this, my thought was, I don't see how you can make any money on this. Typically, when you read about a married put, you hear married put defined as buying shares of stock and at the same time buying in out-of-the-money put options, maybe only 1 or 2 months out in time. So I might have looked to buy GMCR, 200 shares at $54.20, and at the same time, maybe I would have purchased a 47.5 or a 45 put for May 2009 and only paid maybe $1 or 80 cents. Now, that does protect your position, but the problem with using a short-term out-of-the-money put is that the stock needs to drop to $45 or $47.5 before the insurance policy kicks in. So I would be risking more than roughly 10-15% on the position, and we're going to show a little bit later why that is too much to risk. So Kurt reversed that idea when he first started developing these techniques. What he did is he went in the money. He bought a put that was higher than the current stock price at $65, and he went further out in time. Some of the discussion we had on Saturday's presentation, the paid seminar, was reviewing the core concepts. The core concepts of radioactive trading are FIST, force and ideal size trade, the ATM bell curve, meaning when we're at the money, when we have a strike of a call or a put that's at the money, that's typically when we want to sell because the time value is swelled up. And if we're out of the money or in the money, that's when the time value is low and we might look to purchase. But also, to maximize our annualized return, the third core concept is the red line, radioactive decay, where an option loses its value typically in the last 30 days. So when we're selling, we want to sell short, and when we're looking to buy, we want to go longer term so the option doesn't decay as rapidly. All right? So here is his setup on April 22nd. He's got $70.90 into the position. Now when I first saw a setup like this, I said, well, Kurt, I don't get it. You're going to need the stock to move up to $70.90 before you can make any profit. And if the stock, let's say, went up to $71.20, I'm sorry, $71.10, you'd only make $1.20. That doesn't, I mean, with almost a 25% move, that's not a great profit. But that's not how the put options work. Because we bought it far out in time and in the money, what happened was 8 days later, on April 30th, when Kurt was in a live seminar, GMCR popped up to 72.10. But the put didn't go to zero. It still retained a lot of its time premium, and it had a value of $9.70. Now, don't get me wrong. We lost value on the put. We originally purchased the put for about $16.70, and after this move, when the stock jumped up $18, the put was only worth $9.70. So we lost $7 on the put, but in order for that to happen, we gained $18 on the stock. So the total liquidation value, Kurt turned around and just sold to close the shares of stock, sold to close the put, and he took in $81.80 per share, Remember, his original investment was $70.90. So rather than my expectation of saying, hey, you'd only make $1.20, Kurt was able to make a profit of $10.90, or 15% in 8 days. Now, does Kurt see this type of return on every trade he makes? No. This is what's possible. When we enter into a married put position, we have a limited risk. In this case, it was about 8 or 9% of our total investment. Remember, we're guaranteed to get out of the position at $65. So even though our original investment was $70.90, at any time between now and September expiration, even if the stock plummeted down to $20 per share, we could have exercised the put, sold to close our stock at 65, so we were only risking $5.90 on the total position with the original investment of $70.90. But because we didn't sell a call, because we weren't doing a leveraged spread, we have an unlimited upside profit potential. So when the stock took off, Kurt was able to get very good profits. Now, this is just the original setup. This is what's possible. What comes later, of course, we're going to discuss the income methods. And the income methods will help us adjust the position as we move forward if the stock just moved up 4 or 5%, maybe if the stock dropped 6 or 7%, and we're going to show some good examples of that later in the presentation. Well, what's the problem? Well, the problem with trading stocks and options is we just don't know the future, do we? That particular position on GMCR had a great gain, and I will admit, of course, that that gain was because earnings came out shortly after Kurt had entered the position. Did he look specifically to enter into a stock where earnings were coming up in 8 days and he was hoping for the pop? Not really. That's not what's described in the blueprint of how you enter a position, but it can be helpful. In this case, it just happened. But the problem is we just don't know the future, do we? Here's a chart of a very volatile stock. I believe this is, it's XL Maritime Carriers. I'm sorry about that. It's XL Maritime Carriers. I don't know how many of you remember the Greek shipping stocks. I myself had my best trade and my worst trade on dry ships. I started tracking dry ships at 17. I bought shares of stock before I could even sell a call or do another adjustment with options. The stock was trading at 25, then it moved up to 30, then it moved up to 40. I sold it at about 60. I was only trading a couple hundred shares, so it was still a fantastic gain. And then it kept going up. Bought back in at about 90, followed it up to 120, sold it again. The stock kept going up. I mean, this is a great return. But then what did I do? I bought shares around 130 when it was near its peak. And I don't know how many of you remember this, but it just plummeted right after that. And eventually the stock ended up trading back down at about $40, $50 per share. And I tried to leverage down, I tried to sell some calls, but dry ships was my best and worst trade during that time period. But you can see where the problem is here. There's a lot of opportunity on this particular chart to make money. We could buy here in the valleys and wait for the increase. We could short at the peaks, and as the stock dropped down, we could buy back down in these lower ranges. But especially with a volatile stock like this, we just don't know the future. That position we just discussed, GMCR, hey, great, it had that great move after the earnings announcement, but if the earnings were poor, couldn't that stock also have dropped 18 points? That's why we use the put as protection for long stock positions, because we don't want to get caught with a 20, 30, or 40% loss. The reason why is that math doesn't behave like we expect it to. This is part of the reason why most investors haven't discovered what Kurt refers to as the holy grail of trading. Now, if we just look at basic common sense, and if Kurt would have asked me this 3 years ago when I was on the phone with him, if he would have asked me, hey, Mike, if you're trading a long stock and that stock drops 10%, what would you have to gain to get back to break even? Now, a lot of us would answer, hey, I just need a 10% gain to get back to break even, don't I? Well, the answer is no. I would need about an 11.1% gain in order to get back to break even. If I had a 25% loss on a stock, if earnings came out and it was poor and the stock just plummeted, and I had a 25% unrealized loss, I haven't closed it yet, essentially I need a 33% gain just to get back to break even. If I have a 33% loss, I'm going to need a 55% gain, or a 50% gain just to get back to break even. Now this is what we're seeing here. 10% loss, you need an 11.1% gain to get back to break even. This is referred to as gambler's ruin, the Martingale. as I go higher with losses, if I have that 33% loss, we need a 50% gain just to get back to break even. And of course, if we suffered a 50% loss on our stock, we didn't have any protection in place, or if we even had a stop order